Hey guys, welcome to The Market is Open. Don't visit our website, themarketisopen.com. In this video, we're going to go over some of the points made about Tesla in this video that we made on our main channel with regards to legendary investor Steve Eisman's portfolio. Definitely check out this video, which is a walkthrough of Eisman's stock portfolio. In the video, Josh, who does the channel with me and has mainly been focusing on the main channel, The Market is Open, or TMIO1, whereas I've been working on the Tesla exclusive channel. So I'll refer to the other channel as TMIO1 going forward. So on that channel, Josh talks about how Eisman has been shorting Tesla, and the details of that position are given in that video. TMIO1 does a valuation of Tesla which is pretty negative and supports a lower price for Tesla stock. So in this video, I wanted to address some of those points made in the Steve Eisman video. Also, to be clear, it was investor Steve Eisman who was actually shorting Tesla. TMIO1 is negative on Tesla, but he's not shorting it, so that would be ridiculous. We made it pretty clear, even in that video, that shorting Tesla is a terrible idea, even if you're negative on the stock. So before we begin, please hit the bell button to subscribe and be notified of upcoming Tesla videos, and smash the like button to help support this video. And you can also support us further on Patreon at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Okay, so the overall point made in the TMIO video is that Tesla is at $1,000 per share now. As of today, the stock has actually run up to about $1,100 per share. But although Steve Eisman covered his short position at around $800, he took a huge loss, and now that Tesla has reached $1,000, it may finally be overvalued here. So the video starts by looking into the overall size of the global auto market for EVs in 2030, showing that electric vehicles will make up somewhere around 16% or 24%, depending on the source, of new vehicle output that is hitting the road. Keep in mind that even if the world started producing 100 million EVs per year starting today, so 100% of the output is EVs, it would still take 20 years to replace all of the 2 billion ICE cars on the road. So we're just talking about new vehicles produced per year. The chart on the right assumes light-duty vehicles, so for example, semi-trucks wouldn't be included here, but because TMIO1 is looking at the higher of these two estimates, it's still conservative as it's better for Tesla. That said, there's many countries that have started to ban the production of new ICE vehicles by 2030, so that's one driving force. But also, the 76% of automakers that are still producing ICE vehicles in 2030 are still going to be ripe for disruption, which would mean that Tesla would still have room for more growth at that time. So to take a step back, basically TMIO is trying to use really good estimates for Tesla and then later on show that the stock is overvalued because even in the best case, the valuation is still lower than today's price. However, I'm going to try to explain why Tesla is not overvalued, but let's move on and see how this plays out. So the premise for the next part here is that TMIO1 is taking Tesla's current vehicle production and growing it until 2030 until it tops out at 10 million vehicles, which would make it the size of Volkswagen or Toyota and one of the largest automakers in the world by volume. Tesla is already the largest in the world by market cap despite only selling 367,000 vehicles last year in 2019. The rest of the numbers on this page are estimated based on a 35% vehicle growth rate. But keeping this in mind, TMIO1 says that having Tesla be this large may be unrealistic because its market share would have to be 42%. Because as we said before, we estimated that 24% of the car market would be producing EVs. So my argument to this is that there's no law or rule that states that Tesla's sales must stop at 10 million vehicles in 2030 or that 42% market share is not possible. The video does mention that in the last couple years, the tech industry has been a winner-take-all type of business, but then says that this may not be the case for Tesla. However, the times are changing, and if the large and slow-moving automakers don't get their act together, then they will be wiped out. This chart assumes that in 2030, all the automakers that exist today, or rather the capacity that these automakers are able to bring online, will also exist in 2030, meaning that most of the automakers of today are still in business in 10 years from now. I would say that if any of them fall behind or a percentage of them go bankrupt between now and then, this leaves room for companies like Tesla to increase market share and to take their place. This chart also assumes that Bloomberg is correct with its estimates for 2030 about the size of the EV market. However, Bloomberg, as well as most forecasters, have trouble predicting things 1 or 2 years out, so having an accurate 10-year crystal ball is unlikely. Tesla sales aren't bound by the size of the EV market relative to the current size of the gas car market. As Tesla grows, it will simply take gas cars off the road and replace them, similar to how smartphones replace dumb phones. Currently, the car market is very fragmented, with many large and small players, while the phone industry is dominated by 2 or 3 major players. It would still be a big bet, but there's no reason why the car industry can't have similar dynamics to the phone industry. Furthermore, according to Clean Technica's sources, Tesla had 78% of the EV sales in the US last year, albeit on a smaller scale since the EV market is still small. But if Tesla keeps pace with the growth of the rest of the market, then its market share can remain fairly high. Okay, so now we're going to get a bit more technical and dive into the cash flow analysis model. TMIO1 uses the 10% EVs by 2030 and 42% Tesla market share in his calculations to show that even in the best case, Tesla is overvalued. At the same time, over the years, the average price of Tesla vehicles will likely come down, which will effectively help Tesla reach that 10 million vehicle mark. This makes sense, I think, because Tesla lowers the prices of their vehicles constantly as batteries continue to get cheaper, but also we can assume that a cheaper $19,000 vehicle in the future, for example, something that Tesla has alluded to, and we've been calling it the Model 1 in our past videos, but that could have high margins and really hit the mass market. And that would allow Tesla to expand to 10 million vehicles, because the current lineup may be limited to a couple million vehicles per year. You really need a cheap car to hit the mass market and expand your market share. So this free cash flow analysis also tries to take into consideration the capex for building out gigafactories to predict the future cash flows. It doesn't directly take into consideration things like new products, especially ones that we don't know about yet, which is totally fair. It's definitely difficult to estimate that, but I think investors do think about it when they look to the future of Tesla, which may result in a premium price today. For example, people believe that Tesla will have a delivery van in the future. However, that's not at all in their current roadmap. Elon tweeted about this as a side note one time, but in 10 years from now, I mean, it's possible and a logical step that Tesla could have some sort of delivery van. Elon Musk has said that Tesla is like 12 startups in one. So this valuation is focusing on automotive, but there are some kicker parts of the business that could expand the valuation down the road. In addition, the spreadsheet doesn't directly look at Tesla Energy either. The assumption here is that automobiles are a much larger portion and eclipse energy. I think that if we saw a large growth spurt in energy, I mean, Tesla Solar has in fact been lagging quite a bit, but there are new products being rolled out like Solar Roof, but it still needs to grow dramatically to even move the needle compared to automotive. So if we saw a large growth spurt, I think the spreadsheet could be adapted to reflect this and updated, but currently I think investors are thinking about it when they invest in Tesla. We can also talk about autonomous driving as well. However, FSD is currently baked into the car prices in this spreadsheet. Tesla currently shows what people are paying for full self-driving, but if it adds a completely new revenue stream within the next few years, then that could change things a lot. I mean, ARK Invest thinks that self-driving will eclipse automotive, but at the same time, they have a certain probability that it won't happen baked into their own models. And by the way, this spreadsheet is available on patreon.com/themarketisopen for free. If you're interested, download it and you can modify the numbers and see how it affects your Tesla estimates. So I think it's difficult to value Tesla because there is a core business with a few smaller businesses that surround it that have potential. But when doing a cash flow analysis, it's difficult to take all of these moving parts into consideration. So this chart here from the video shows the sensitivity analysis. It determines a value of $756 per share as a result from the calculations on the previous slide. For the current value of Tesla, assuming 4% terminal growth with a 9.1% discount rate to present value. So what that means is that Tesla will grow at 4% after 2030. I think that could be low if we look at companies like Apple or Microsoft, which are each $1.5 trillion companies today. They're still growing much faster than 4%, maybe 15 or 20% for Microsoft. So if you're unhappy with the 4% number for Tesla shown in the chart, as you move to the right of the chart, you can see estimates assuming 5% or 6%, and Tesla's valuation would increase to $1,200 today if it had a 6% terminal growth rate. So you can see that small fluctuations in future growth could have drastic impacts on today's valuation. And I think that's one of the reasons why it's very difficult to value Tesla. It's a bit like trying to fire a rocket at an asteroid that's a light year away. If you're off by 0.5% degrees, you'll miss the asteroid by 1,000,000 miles. So this analysis, which ranges from 2% to 6% in terminal growth and 8% to 11% in discount rate, can cause today's value of Tesla to range from $296 per share to over $2,000 per share. So that's a gigantic range, which shows the extremely high sensitivity of this model. Finally, there's an argument here that Tesla's lead in vehicle range is getting a lot smaller. I think this is a bit misleading. It reminds me of when specs were of the utmost importance for the iPhone versus the competition. iPhone was the thinnest phone, and Apple made it clear in every presentation that it had the best and thinnest phone. Now, they stopped commenting on that once the competition caught up, and now phone thinness isn't really an issue. However, it did weed out the companies who simply couldn't keep up. Now, I think the real differentiator will actually end up being software. With the elite few automakers who finally catch up on EV range to be satisfactory, software will then start to matter a lot more. Currently, most automakers write very little of their own software, and so that might be the deciding factor as opposed to range. Tesla has been light years ahead on software, and they've been refining it for the last decade. We've already seen software issues come from Volkswagen and Ford, and Volkswagen employees admitting that 90% of their software is written by third parties. So to bring that in-house, first you would need a lot of internal talent, but your suppliers may not be very happy as well. So that's my overall analysis of TMIO1's analysis of Steve Eisman's short position in Tesla. I think that Tesla stock has always been seen as being overvalued. However, looking at the future growth potential of the company, even just small fluctuations in growth can make Tesla significantly more or less valuable than the average projection. And so I think that's very important to consider, and pretty terrible reason to short Tesla and to jump in front of a company that continues to grow rapidly and innovate. And finally, we have a new feature on our website, themarketisopen.com, where you can create your own stock portfolio. You can enter in your stocks and even how many shares you own of each, and if you switch to make it a public portfolio on the bottom right here, you can share the URL of your portfolio. So I'd encourage you to build your own stock portfolio and share it with us in the comments section below. We'd be very interested to know what other stocks of companies you own. Also, be sure to check out the full Eisman video on youtube.com/themarketisopen, and I'll put a link in the description below. And let us know what you thought of the free cash flow model from that video. So I hope you guys enjoyed this video. Please hit the like button, we'd super appreciate that. And also hit the bell button to subscribe and be notified of upcoming Tesla videos. Join us on Patreon, where we give a shout out to our patrons at the end of each video. Thanks so much for watching.